Welcome back to the channel, everyone. Today I want to explain why Fidelity is corrupt and why we should stay away. To cut a long story short, you may remember proposed rule 10C-1, which increases the transparency and efficiency of the securities lending market by making public certain information regarding short positions. Fidelity have basically said that they don't support this rule and they do not believe shorting should be made public. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So here's rule 10C-1. It says the SEC is proposing a rule to increase the transparency and efficiency of the securities lending market by requiring any person to report the material terms of those securities lending transactions. And they also have to make available to the public certain information concerning each transaction and aggregate information on securities on loan and securities available to loan. So Fidelity actually submitted the letter containing their comments. They've said our comments on the proposal focus on the following areas. The SEC should exclude short positions from the proposed rule. The reporting timeframe for transactions should be no earlier than end of day, and there should be no intraday reporting. The SEC should provide market participants additional time to respond to the proposal and therefore delay the proposal further, and the SEC should provide a minimum 2-year implementation period for any final rulemaking. So this is basically saying that Fidelity don't think that short positions should be reported publicly and that they should wait at least 2 years before making any kind of reporting final. So basically they can kick the can for another 2 years and continue illegally naked shorting stocks or supporting the use of naked shorting and won't face any trouble. I personally think these comments from Fidelity are very, very concerning. If Fidelity don't support the transparency of short transactions, what do they support? Do Fidelity have their fingers in the pies of some of these hedge funds and institutions that are already shorting AMC and GameStop? And do Fidelity stand to lose a lot of money? When AMC and GameStop squeezes, are Fidelity going to continue to be the positive broker? Or are they going to turn off the buy button? Are Fidelity secretly accepting payment for order flow and selling their transactions directly to Citadel and not being entirely honest with us about how transactions are routed? Not too long ago, there was the Fidelity glitch on the number of shares available to short for GameStop, which massively curbed their recent rally. What if Fidelity are actually supporting the shorts and not against them? Also guys, if you want to get some free money, be sure to sign up with Moomoo using the link in the description below. They're currently giving away 5 free shares valued up to $3,500 each and a free share of AMC when you sign up for Moomoo and make your first deposit. You get your first free share just for opening an account. You get the second free share for making a deposit of any amount, even if it's only a single dollar. If you deposit $100, you also get a free share of AMC, and if you can deposit $2,000, you get an extra 3 shares on top of that, entirely for free. Moomoo also has excellent technical indicators and advanced charting tools, and Moomoo is very, very easy to use. They also publish daily short selling volume on top of a number of other important pieces of data. And most importantly, Moomoo don't make their money from payment for order flow. Moomoo and Futu make their money from margin interest and from payment fees, and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. Now Space Minion has noted a similarity from a number of the big players that made some comments, saying there's a lot of pushback on intraday reporting. He said, I'm going to guess the big guys are looking to only have to report netted positions where they can skirt around settlement rules and fake the data. The intraday reporting will be paramount to ensure they don't lend at certain times to change momentum and then re-engage the loans. It'll also provide more visibility to daily strategies by funds to utilise swaps throughout the day instead of as a longer term position. And he said secondly, if ARK, as in Cathie Woods' funds, can provide daily reporting of trades, this should be a minimum as standard. Obviously we know that 13Fs are only provided every quarter, but Cathie Woods and ARK can daily report their trades, and therefore if Cathie Woods and ARK can do it, then surely every fund can make daily reports. I think intraday reporting is going to be crucial because we know that many funds and institutions are shorting in the morning and covering in the afternoon to try and push the price of AMC and GameStop down. If they're only reporting at end of day, none of these shorts would actually ever be reported. But obviously if they have to report intraday, then all of these ladder attacks would be uncovered because they'd have to report every time they make a short and every time they cover that short. So Firebase has summarised some of the other replies and comments. BlackRock want a bit more definition, the DTCC want to dodge reporting of novation and netting, but Morningstar do actually recommend the public disclosure of the legal names of the party, so to actually improve upon Rule 10C-1. The New York Stock Exchange believe the public disclosure of short sell positions has been described as a threat to proprietary investment strategies. On the other side though, FINRA do actually support and want to facilitate this important initiative to improve the transparency of short reporting. It's so interesting how clear-cut the line is between those funds and institutions that don't want to improve the transparency of short transactions and those institutions and funds like FINRA and Morningstar that do want to improve that transparency. I personally think publicising things like short transaction data and insider trading data is a brilliant step in the right direction. Obviously, recently, Unusual Whales tweeted some of the profits generated by politicians compared to the profits of the S&P 500 over the last year or two. That obviously encouraged a reply from Jack, the founder of Twitter, who has 6.1 million followers, and a reply from Mr. Beast, who has 13 million followers. Mr. B said, "Why is it too much to ask that our politicians just focus on helping our country? And who in the right mind thinks that trading stocks is okay for them?" Now this is obviously something we've been pushing for some time now. The only problem being is that in our niche, people tend to have much smaller voices and less outreach. Trey only has around 246,000 followers. Unusual Whales only has around 449,000 followers. Much smaller than Mr. Beast's 13 million followers. I think if we can get more people involved that have a much larger outreach like Mr. Beast, then more and more people across the US and across the entire world are going to know about things like insider trading and also the nefarious and malicious short transactions and abusive short selling. And this is why I personally think that Trey's attempt to chat to Mr. Beast about abusive short selling and insider trading is a brilliant move in the right direction. Now I also wanted to talk about mainstream media's reaction to Citadel's bailout. MarketWatch said Citadel's $1.15 billion cash injection is not a bailout, but the final test of Ken Griffin's Death Star. MarketWatch posted this article saying a $1 billion investment into Citadel is a warning because Citadel are about to become even bigger than they already are, apparently. This entire article talks down on the apes, calling us monkeys, and says that we're massively wrong and that Ken Griffin and Citadel are going to get even bigger. I find it funny how MarketWatch have tried to protect Citadel and tried to again change our minds when we're so obviously on the right track. Now you probably already know that Citadel owns News Corp or News Corporation, which is the company that owns MarketWatch, and therefore that article has literally been written by Ken Griffin himself. And as said by Marco Metzler, Citadel is so desperate that it's raising external capital for the first time. He said if Citadel were to go under for good now, this would be reflected in kohrs investments as well. So it seems Griffin's golfing friends have had to help him out once again, even if it must be humiliating for him to have to sell his shares for the very first time and no longer be the 100% shareholder of the most hated hedge fund in the world. I think it absolutely shows that we're on the right track with this investment actually being a bailout and that Citadel is not getting stronger, Citadel is actually being bailed out. This attempt at a FUD article just gives us even more confirmation bias that we are on the right track. And as this post says, Shills, your very presence here is proof of positive confirmation. This user says he avoided GameStop and AMC until he saw all of the Shills and FUD articles back in February of 2021. And he said, why do all of these people and bots care about my money so much? And he said one thing always pans out to be true. If a bunch of people are focused on your wallet, it's not to make your wallet grow, it's to try and steal your money. He said people only care about your money if they can get their hands on it, or if it affects their money. I've also noticed myself in my YouTube comments there's been a massive increase in the amount of bot and shill comments trying to convince other people to sell AMC and GameStop. But all of these news outlets and shills wouldn't be telling people to sell GameStop if it wasn't affecting them in some way. I personally think that due to this massive increase in the number of shill comments and the number of FUD articles, that we're getting closer and closer. I think Fidelity's attempt at trying to get this new rule 10C-1 extended for an additional 2-year implementation period, again, just goes to show how close we really are. And this poster says if AMC and GameStop really was that bad of an investment, like the media says, the company would have already gone under and AMC would have already been shorted back to $2 and below. Both AMC and GameStop would be struggling and the stock price would tank lower and lower to new all-time lows below $2 a share. And there'd also be tons and tons of negative retail investor sentiment because there'd be tons of people not going to GameStop stores and not going to AMC theatres because they knew that the companies were dying, which obviously most definitely isn't the case because these companies are not going under. Guys, if you were to let me know down in the comments below what you think about Fidelity not supporting more transparency in short transactions. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.